There's a big debate going on right now in the market, not so much about how aggressive the Fed will be, but I guess more importantly, whether the Fed will be able to engineer that proverbial soft landing.
And it's one of the toughest things to try to do because they've been a little bit behind the curve. They let inflation get a little bit higher than they would have liked. Kept talking about it being transitory, wasn't transitory. Now they've gotten religion and they're moving quickly, or they're hoping to move very quickly. And that's really, really tough because the economy is clearly slowing down. GDP print was a little bit lower than had been hoped for. I think with the continuing war, sanctions, continuing supply shocks, we're going to see the unemployment rate going up. We're going to be seeing GDP growth slow, but they still need to raise those rates. I think the probability of recession has gone up quite significantly. They still might be able to do it, but it's going to be really tough.
It's going to be really tough. And I'm curious if when you look back at past rate tightening cycles and the economic conditions that were around then, are the conditions today worse than they were in some of those previous rate hiking cycles?
Well, they're very different because what we've had with the pandemic is just so unusual, having these contractions of like a 1/3 of GDP annualized rate, and then growth of 5 or 6% suddenly, and then you've got war, sanctions, all that. So it's really hard to use the past as a very useful predictor of what's going to be going on now, and that's why it's one of the toughest things for the Fed. But I think they really do have to continue on the path for increasing their rates because they have a window right now. They haven't lost credibility. So unlike in the late 70s when the Fed had lost credibility and Volcker had to raise rates to 19% to bring the inflation rate down, they don't have to go that far if they move quickly. But if they don't move quickly, then they risk losing credibility and then have to push rates really high, and then that'll push the economy down much further.
Well, that seemed to be part of the sort of negative market reaction that we saw after the last Fed meeting when we only got a 25 basis point cut. And more recently, Powell has signaled that a 50 basis point cut is certainly on the table at the meeting for discussion next week. And there are a lot of people think that there will be more than one 50 basis point increase, I should say, over the course of the year here. Does that constitute an aggressive enough pace to get us to where the Fed wants us to be?
Well, it's certainly, I think it's as aggressive as the Fed wants to be, at least right now. And as I said, they have this window because they've not lost credibility over the last couple of weeks. Inflation expectations have started to move up more rapidly. And that's the thing that's really scary for central bankers, because if they lose credibility, if inflation expectations aren't moving up, they've got to move up much more aggressively. So what they'd like to do is move quickly now. Paul Volcker is now being invoked by Jay Powell. Yeah. He hadn't talked about him before, and now he's bringing him in because he wants to say, I'm gonna do it. I want people to believe that I'm going to do it, and hopefully by invoking him, he won't have to do it as aggressively and as Volcker did and go to double-digit levels.
Well, he certainly rattled markets when he invoked Paul Volcker's name and Paul Volcker's methods. I am curious. There's sort of a broader, I guess, theoretical question here as to what the Fed is managing. Are they managing inflation? Are they trying to tame inflation itself? Or is it more about the expectations around it that they're focused on?
I think it's primarily the expectations around it, because a lot of the shocks are coming on the supply side that are outside of their control. Some of it does have to do with demand, for sure. Monetary supply growth has been very strong, and so it's partially from Fed's actions, but partially from outside. The main thing that they have to worry about is that unanchoring of expectations that we're starting to see a little bit of evidence of, not enough yet, and that's why the Fed needs to move quickly. Also, I think politically, it's much more difficult for the Fed to start moving when the unemployment rate is 5-6% than when it's below 4%.
Well, that leads to a kind of a key point, the idea that we've never really had a soft landing in a rate hiking cycle when the Fed has had to push the unemployment rate up. Do you buy into that?
Well, it's something that's very difficult to do. But as I said, I'm not quite sure that if you just look at the previous cycles, it's exactly like what we're seeing now, because there's so many unusual circumstances. But I do think that one of the challenges is that in the old days, like when Volcker was there, people understood that the Fed has to take the punch bowl away at some point because it can be overheating. Over the last 20, 25 years, the Fed's not been taking the punch bowl away. It's always been trying to provide support if there's a sort of a negative shock. And so we've now had a generation or two of both people in the markets as well as policymakers who have not seen the Fed try to pull the punch bowl away.
Yeah.
It's always been seen as something to provide support. And that's why I think it's going to be much trickier politically for the Fed to do the right thing. I mean, Volcker, of course, had it really tough,
Right.
but there were a lot of people who understood he needed to do the right thing. Now, there are not that many people around who experience that and understand what the right thing is to do.
Well, let's talk a little bit more about that punch bowl, because the punch bowl is a lot bigger today than what it was back then, and it's probably a little bit more layered. I mean, you were at the Fed back in 06, 09, kind of with the sort of the dawn of the global financial crisis. A lot of the accommodative policy that is in this market right now was born out of that crisis, out of that recession that came out of it, whether it's the fourth iteration of quantitative easing or the near zero rates that we've been at. Basically, a lot of policies that came out of that are still with us today to some degree or another. So instead of just sort of trying to reverse the own policies that Powell himself has overseen, he's now effectively trying to reverse policies that two previous Fed presidents have overseen.
Well, to some extent. I mean, the response to the global financial crisis, I think what we did was necessary to prevent the Great Recession becoming the Great Depression. And then we had a decade where inflation was very low. And then the pandemic hit, and then then Jay and his colleagues sort of opened the same playbook to make sure that we didn't have a collapse of the economy. And I think that was exactly the right thing. The challenge was that there's been so much more fiscal stimulus, both in the U.S. and globally, than there was previously. And you then have supply shocks, and then you have war and sanctions, that it's been a much more complicated set of things for the Fed to respond to. The challenge was that it would have been much better if the Fed had not said, this is all transitory, this is just supply shocks outside of our control. We can take our time to deal with it. If they had acted a little bit earlier, we wouldn't be quite in this pickle. But I think they now realize they need to move quickly to do it. I think a significant slowdown would have been inevitable, even if they had started earlier, because of all the other shocks that are coming in.
Yeah.
But I think the probability of a recession is much higher than it had been.
Well, Powell, at least publicly, is of course trying to talk that idea down here. I want to bring you some of the comments that he made back in that March 21st speech before the NABE conference, where he effectively said that there have been recent examples of the Fed hiking into this type of environment and avoiding recession. He specifically cited 1965, 1984, and more importantly, he invoked Alan Greenspan's name with that rate hiking cycle that we saw in 1994, where we effectively went up 3 full percentage points in barely a year's time. And he uses that as an example, at least in his words, that you can avoid a recession and at the same time tame inflation.
That's for sure. It's by no means necessary. And so I think the Fed could do it. But I think you're in a very different position. I think 94 is probably the closest example, both because it's closer in time and trying to bring inflation down relatively quickly, making sure inflation expectations don't get out of control. But we're in a very different environment. We're in a war and there are major sanctions that are in place. Mm-hmm. We are facing lots of supply disruptions. So it's a different environment than in 94, and I think a trickier one. And it's, it doesn't really matter whether it's the Fed's fault or not. The Fed owns it. If inflation is high because of supply disruptions or sanctions or war, the Fed can't say, well, it's not our fault. The Fed owns high inflation and has to respond to it. And that's why I think a lot of it is about inflation expectations and not just the particulars of what may be driving inflation in one particular month or another.
All right, well, here in 2022, final question here for you, Dr. Kroszner. If you were still on the Fed committee, would you advocate for a 25 basis point hike, 50 basis points, or something more?
So I think they need to move 50 at the next meeting and also give a very clear plan for starting to reduce the balance sheet. I think the Fed is going to continue to focus on the interest rate as their main policy tool. I don't think they're going to say, oh, well, we'll use the balance sheet as a policy tool. But I do think that they need to give a clear plan for the runoff of the balance sheet. So it effectively would be more than a 50 basis point cut because they'd be talking about pulling back the balance sheet.